I've been working on my 2023 investment plan, and Roth IRA is our core retirement account. And my wife and I each have a Roth IRA because legally we can't combine retirement accounts. But we have a joint investment plan going into 2023 because we've had a combined budget since we got married 6 months ago. And I've been maxing out my Roth IRA contributions or the backdoor Roth IRA conversions since 2016. And I want to share what I have so far in my Roth IRA. I also want to share some of the common mistakes that people make with their Roth IRAs, and you want to try to avoid them going into 2023. And I'm truly excited that the Roth IRA contribution limit has finally increased from $6,000 to $6,500 starting on January 1st, 2023. And it's been 4 years since the IRS increased the contribution limit from $5,500 to $6,000. And if you're 50 or older, your catch-up contribution is still $1,000 on top of the $6,500 because the law doesn't increase the catch-up portion based on inflation. Before I get into the top 5 mistakes people should avoid with their Roth IRAs going into 2023, I want to point out the fact that there are only 21% of US households own Roth IRAs in 2021. So if you have any friends or families who don't know anything about the Roth IRAs, I strongly recommend that you share this video to help them get started. If you're brand new to my channel, my name is Sai and welcome. My channel is all about how to achieve financial independence and retire early. I'm 36 years old and I've been on my Fat Fire journey for the last 6 years, and I went from $110,000 in consumer debt to managing over 7 figures in total assets. Ever since I paid off my stupid debt in 2016, I've been consistently saving over 65% of my gross income, and the Roth IRA contributions are a part of that 65% savings rate. My plan is to contribute $6,500 to my traditional IRA and then convert it to my Roth IRA, also known as the backdoor Roth IRA due to my household income. My wife and I are collectively investing $13,000 total just in our Roth IRAs. So by the time we turn 60 years old, we should have anywhere between $4 to $6 million invested just in our Roth IRAs. And I'm going to show you how we calculated that later on in this video. So mistake number 1 I always see as a financial coach is people not creating a spousal Roth IRA for the non-working spouse. That's right. You can be a stay-at-home parent or spouse and still be eligible to contribute to your Roth IRA as long as your other spouse is actively employed and making income. If you're the non-working spouse in the family, you can contribute up to $6,500 to your Roth IRA on top of the $6,500 your working spouse contributes to his or her Roth IRA. You and your spouse also have to file taxes jointly in the same tax year you're contributing to your Roth IRAs. I want you to keep in mind that your Roth IRAs have to be under 2 separate identities or social security numbers, but you can contribute to the 2 separate Roth IRAs from the same joint checking account. So it doesn't really matter whose name is on the joint checking account, and the non-working spouse can make decisions on what to invest, how to invest, and how to make withdrawals. Now, take a look at the impact your spousal Roth IRA could have on the long-term retirement plan. And I don't plan to touch my Roth IRA until I turn 59 and a half, and it's not one of my income streams when I hit my early retirement age at 45. So let's assume that you're 28 years old, since my average audience is between 25 and 35 years old, and you have nothing invested in your Roth IRAs. Starting in 2023, you could contribute up to $13,000 or $6,500 to each of your Roth IRAs. I'm also going to assume that the Roth IRA contribution limit increases by $500 per person every 2 years. And then when you turn 50 years old, you get that extra $1,000 in catch-up contribution. If you consistently invest in something like the S&P 500 that can potentially perform 10% in annualized return, you could have over $4.2 million by the time you turn 60 years old. You'll hit that $1 million mark by age 47 with an 8% annualized return. You could still have $2.8 million by the time you turn 60 years old. With a 4% withdrawal rate, you could enjoy up to $112,000 a year in tax-free income for the rest of your life. And you can get this spreadsheet and my other financial independence resources for free by visiting firesidechat.com/contact. You can also check out the Fireside Chat shop if you're looking to start your own YouTube channel, and I have all of my equipment at firesidechat.com/shopping. And common mistake number 2 I often see is not understanding the following basic terms for the Roth IRA. contributions, conversions, earnings, and rollovers. Let me break it down for you so you don't make any mistakes that could cost you heavily in taxes. A contribution to your Roth IRA is what you directly contribute or transfer from your bank checking account to your Roth IRA. This is the money you already paid taxes on, so you can actually withdraw your contribution from your Roth IRA at any time. So for example, if you contributed $6,500 and you accrue $500 in earnings, you can withdraw what you contributed at any time, tax-free and penalty-free. And speaking of earnings in your Roth IRAs are however much you earn from investing in a mutual fund, ETF, bonds, stocks, or other qualified securities in accordance with the IRS. You cannot withdraw your earnings and interest until you turn 59 and a half, tax-free or penalty-free. If you withdraw that $500 in earnings like I used in the previous example, and assuming you're in the 24% income tax bracket, you would have to pay 24% of the $500 in earnings and an additional 10% in penalty. That's a total of 34% in a penalty, or $170 in total taxes when you make an early withdrawal of your earnings. A conversion is if you decide to pay taxes on what you have in your traditional IRA or other pre-tax retirement accounts, and then you convert that money over to your Roth IRA. So anytime you do a conversion, you'll have to pay taxes on the total conversion. Let's say you want to convert a traditional 401k with say $10,000 that you got from an employer you no longer work for. You would basically roll over the traditional 401k to your traditional IRA, and then you convert that $10,000 from your traditional IRA to your Roth IRA. You would have to pay income taxes on the $10,000 you converted from your traditional IRA to your Roth IRA. And a rollover is when you directly move money from Roth 401k, Roth TSP, or other Roth accounts transferred to your Roth IRA, and you won't have to pay any taxes on the rollover because you already paid them. And it has to be a Roth to Roth rollover so the IRS can't tax you twice. You also can't do a rollover from Roth to traditional because you already paid taxes on the contribution. And if you're still confused about how the Roth IRA works and you need help with your personal finances like budget, savings, and investments, you can schedule a free one-on-one 20-minute financial coaching session by visiting firesightchat.com/coaching. Now, let me give you some more common mistakes people make with their Roth IRAs, so get ready to take notes. Mistake number 3 is not understanding the differences between your transactions inside your Roth IRA versus transactions between your Roth IRA and your bank account. Let me simplify it for you. When you buy or sell stocks, ETFs, or mutual funds inside your Roth IRA, you don't pay any taxes on it. But when you make a withdrawal or transfer from your Roth IRA to your personal checking account, you will get taxed on the earnings and or penalized if you're not 59 and a half or have the Roth IRA open for at least 5 years. Again, you can withdraw your contributions at any time, tax-free and penalty-free. And speaking of conversions, that's mistake number 4 I want to bring up. You have to fully understand the Roth IRA conversion rules before you make any conversions, or you can end up paying taxes and penalties. It's also known as the 5-year conversion ladder that many FIRE people use to withdraw their retirement funds earlier than 59.5, tax-free and penalty-free. If you make the conversion in the tax year 2022, then you're eligible to make the withdrawal on that conversion in 2027. You can carefully strategize it by converting some money every year so you can make the tax-free withdrawal in 5 years and then every year after that. And I have a full tutorial on the 5-year conversion strategy linked in the description below, or get with a CPA in the area near you. And mistake number 5 is not realizing how time is one of your ultimate weapons to achieve financial independence. Now, don't get me wrong, I am not saying that just because you're in your 50s or 60s, it doesn't mean that it's too late for you to start investing. You just don't have the time to retire early. It's all about the FI, right? But those of you watching this video in your 30s and 40s have time on your side. And I want you to take a look at my Roth IRA for a second here. And remember, I was telling you that I paid off my debt in 2016 and started maximizing my contribution to my Roth IRA and in the same year. Well, this is how my investments inside my Roth IRA have performed over the past 6 years. And I started with $0 and now I'm sitting around $57,000, but due to the market downturn in 2022, with over 16% in a negative return. But suppose I continue to maximize my contribution and assume the market performs 10% annualized returns over the next 25 years. In that case, I'm going to have well over $3 million by the time I turn 60 years old. Even with an 8% annualized return, I would still have $2.6 million when I turn 60. This is just my Roth IRA, and I'm not even counting my wife's Roth IRA, our HSA, taxable investment accounts, and cash. This is simple math, not a Ponzi scheme. I'm treating my IRA as my core retirement account because every time I leave my employer, I can roll over my employer-sponsored retirement accounts to my IRA so I can manage my own investments and not pay high fees in the 401k. I built my investment plan around my IRA, and it's been working really great so far for my Fat Fire journey. And don't forget that you actually have until the tax deadline to contribute to the previous tax year's IRA contribution. So you have until April 18th, 2023 to contribute $6,000 to your 2022 Roth IRA. And if you want to know more about how to invest in your Roth IRA and learn about the FIRE withdrawal strategy, be sure to check out these 2 videos. So with that said, I appreciate you watching my video. Don't forget to subscribe, and I hope to see you in the next video. Have a good one.